everybody. In this video lecture, I am going to discuss with you about the another demand side policy, and that policy is the monetary policy. This video lecture will be useful for the bachelor students of the commerce, business, public administration, or the economics, or anyone who is interested to understand the basics of the macroeconomics. And in this lecture, I am trying to discuss or explain or share my views with you people regarding the monetary policy. This is the part of the demand side policy. Monetary means it's related with the money. The term monetary means it's related with the money. So this policy is affecting or have impact on the aggregate supply of the money in the economy. Monetary policy is that policy that demand side policy which is used to control the overall money supply in the economy. The ultimate purpose of this policy the purpose of this policy is to either to control unemployment or inflation. Either this policy is used to control the unemployment or inflation, or we can say this policy is used to control the recessions or the booms or the peaks. The policy options available in this policy, in this monetary policy, the tools or the techniques which are used by the policy makers. And before mentioning these tools, must say that monetary policy is run by the central bank or state bank or the monetary authority of any country. In Pakistan, state bank is the authority or the central bank of Pakistan. So state bank is the control on the monetary policy. The tools which are in the part or the technique through which monetary policy is working are interest rate, government increase or decrease the interest rate, printing of currency, increase or decrease, and the reserve requirement, increases or decreases. Depending on the type of the policy, depending on the purpose, these major tools can be increased or decreased. So there are two types of the monetary policy. Types of monetary policy. One is the expansionary monetary policy. It means the purpose of this policy is to expand the economy, and This policy is used by the policymakers, the monetary authorities, when economy is going through the recession. When a country is facing the unemployment, means there is a reduction or the fall in the aggregate demand, or GDP growth rate is not increasing, or the economy of any country is falling, simply we say the recession or unemployment. So in this case, the monetary authorities uses the expansionary monetary policy. Again, I repeat that this is the demand side policy which is used. This policy is used to reduce unemployment or increase the employment opportunities or recession. And when unemployment or recession is going to be controlled, it means aggregate demand will increase, means GDP will rise. So in this policy, expansionary policy, government announces or central bank or monetary authorities increases what they announces. Interest rate will decrease. Our government announces the reduction in the interest rate, but if we are not going to write words, we simply say that interest rate will decrease. This is the first one. So what happens when government or the monetary authorities decreases the interest rate? When interest rate, which is the price of the money, this is the money. Interest rate is simply the price of money. When interest rate falls, what happens? People borrow more. Borrowing becomes cheaper. People can borrow at lower interest rates, and by borrowing they can buy the consumer goods, or even the private investment can increase. So when interest rate falls, people borrow more, and by borrowing they can demand more goods. They can buy more goods. So when they demand more goods, means the demanded goods needs to be produced, so it will increase the aggregate demand in the economy. Another tool which is used by the policy makers, it means interest rate. Interest rate, when it is going to decrease, it encourages the people to borrow more. By borrowing, they can construct their homes, they can start new businesses. Even by borrowing at a cheaper interest rate or lower interest rate, they can buy the consumer items, the durables. The second policy tool of the expansionary monetary policy is printing of currency notes will increase. Printing is the sole power of the state bank or the monetary authority. In America, Central Reserve Bank, the central banks in different countries, and the state bank in our country, Pakistan. But it is nowadays claimed that printing is independent from the government control. But monetary authorities can print more currency notes, allow to print more currency notes to cope up the shortage of the funds. So when printing of the currency notes increases, it means availability of money supply increases in the economy. When more money will be available means the more demand will be there. So when printing increases, it increases the aggregate demand in the economy and economy start improving. So printing of the currency notes can create inflation. More you print the currency notes, then more will be the inflation in the country. Then third one is the reserve requirement. Reserve requirement will fall or decrease. The third tool, which is used by the monetary authorities in the expansionary monetary policy when we want to expand the economic activity, is reduction in the reserve requirement. Reserve requirement is related to the commercial banks. State Bank is impose the condition on all the commercial banks that from all their reserves or from all their the money which they are receiving from the people as savings, they have to maintain a particular or a certain amount of the reserve just to pay in emergency cases. If suppose in any difficult situation people rush to withdraw their money, to meet that demand, they maintain an account with the state bank or the central bank is a reserve account, and from all the savings they have to save a particular amount in that account, and that amount is according to the reserve requirement ratio. So when, if I say suppose banks receive 100 rupees, and if the government has imposed or monetary authorities has imposed 20% reserve requirement, it means 80 rupees will be available because 20 will be maintained with the state bank. This money will be kept in the state bank as a reserve account, and remaining 80 is available for the loaning purpose. So when government reduces the reserve requirement, just suppose I say that 100 is the reserve requirement, and same is the, 10 is the reserve requirement, and 100 is the total amount available in the banks. So now banks have to maintain 10% as a reserve in the state bank account, and now 90. It means 10 rupees more for loaning purpose, available for the loaning purpose. So these are the three tools, major tools which are used, and other also, bonds also. Another technique or tool which is used by the government monetary authorities in the monetary policy is the bonds. Government buy big bonds. Bond is the type of the financial instrument through which government raises its funding or capital. This is the source of the borrowing, and through bonds, government borrow directly from the people. So when government buy the bonds, it means government gives them the money. If suppose I have purchased 1000 rupees bond some time ago, means I have given 1000 rupees to the government and I have only one paper. So when government means I have delayed my purchasing for the future time period. If government buy back the same bond, it means government is giving me the money back along with the interest rate. So I have now money, and that money can be used to purchase the goods and Through this way, we can increase or enhance the aggregate demand. So these are the tools used in the monetary policy by the monetary authorities. So I hope you have understood about the monetary policy, some part of the monetary policy. In the next class, I will discuss with you the contractionary monetary policy. So monetary policy means it is the policy, demand side policy, which is used by the central bank or monetary authorities of any country. In case of Pakistan, the state bank is the monetary authority, and this policy can be used to increase or decrease the unemployment rate or inflation rate. And these are the policy tools: purchase or sale of the bonds, sale of the bonds, interest rate, increase or decrease of the interest rate, printing of the currency notes, reserve requirements, and bonds purchase or sale. And there's a first type of the monetary policy, that is the expansionary monetary policy. Through this way, government is trying to control the recession or unemployment in the economy. In this, government decreases the interest rate, which encourages the people to borrow more. Government increase the printing of the currency notes. It means availability of money will increase. More money will be available to buy the goods, and that will put the pressure on the prices to rise, and which ultimately encourages the producers to produce more goods. Reserve requirement will decrease. Again, it makes funds available. It means it will increase the availability of funds, and more funds will be available for the borrowing purpose. Buying back of the bonds, it means now government has returned the money which government has borrowed from the people, and now people can spend that money to buy the goods. So ultimately it will put the pressure on the demand, aggregate demand to rise, and the GDP will increase. So thank you for listening, and I will discuss in the next lecture about the contractionary monetary policy. Thank you.